Hello, ladies and gentlemen, and welcome to the show this evening. Glad to have you guys here. Today is November 23rd, 2019. And I don't think people in general realize just how much trouble the economy's in and how much trouble the world economy is in. I got an awful lot of stuff to go through here to talk about, so I got a lot of information to cover in a very short period of time. But we're going to get started. Now, here's the thing. Deflation is very, very fast and very, very dangerous for the world's economic system when the system is so over leveraged like it is right now. It can deflate so fast. What a dangerous game we're in right now with the Fed and trying to control deflation because, like in 2008, they said they only had like 2 hours or a whole financial system would have melted down. That's how quick deflation can work. Now, hyperinflation and inflation is much slower. It's kind of a consensus reaction to the people out there that they start to realize that they're losing purchasing power, and it's something that happens over a period of time. There's always a lead-in period to hyperinflation, and that lead-in is called the acceleration phase, where you slowly accelerate in. It's not hyperinflation, but during that acceleration phase, inflation increases rather rapidly until it leads to the hyperinflation. And it's a slow process. It doesn't happen overnight. Deflation can actually happen overnight. You can have a bank holiday. All the banks could be closed after a severe deflation. And, it can happen so fast that the Fed wouldn't have time to react. The system, when it's this over leveraged, could lock up. Now, don't get the wrong idea. Deflation in the right circumstances is actually good in an economy. Prices slowly lowering. If you have a strong, vibrant economy that's not levered up with credit bubbles and enormous bubbles and debt leveraged with debt. But when the system becomes too over leveraged with debt, the whole thing can just basically freeze up. And we've never been over leveraged like this before. This has absolutely gone to the point of being retarded. Okay, so let's get started. Let's open up the charts right here and take a look at what's going on. The first thing we're going to talk about is this article. I don't want to get you guys dizzy, but I got to get my charts settled right here. Let me bring it in here a little bit. Trying to work with this. Okay, Blackstone Group warns of the mother of all bubbles. The Blackstone Group, one of the world's largest private equity firms, $554 billion in total assets under management, sees growing risk for the markets right now, including a largely overlooked mother of all bubbles. Moreover, there are actually the troubling linkages between several negative developments that on the surface appear to be random and unrelated, warns Joseph Zittel, chief investment strategist at Blackstone's Private Wealth Solutions Group. Per detailed Business Insider report as summarized below, it says the failure in the repo market, negative yielding debt, deeply negative term premium trade conflicts around the world, and a collapse of manufacturing all seem unrelated right now, but I don't think they are random, Zittel wrote in a recent note to clients. His biggest concern is negative yields on sovereign debt worth $13 trillion that he believes may be the mother of all bubbles. Okay? So negative yielding sovereign debt on $13 trillion. Now, there's also the corporate bond market. We have right now pension funds have bought in heavily to the corporate bond market on triple B rated bonds for corporations. If the system starts to sink, those bonds are going to get re-rated down lower than triple B. And, there's no bottom to where this stuff can go, quite seriously. And this is an enormous bubble. I think it's like $5 trillion or something like that. Now, we're facing this in light of other things that are going on within the economy at exactly the same time. China's slowdown is enormous. It's much bigger than most people could ever realize. The Chinese right now are the trade thing that's going on, the trade war. It doesn't have that much of an effect actually on the Chinese economy. What's really going on underneath it, underneath the surface, is a general slowdown that would happen anyway as we're on the leading edge heading into this next recession. And it gives the Chinese a way out to say they can blame it on the trade war. They can say, well, it's the trade war that's doing it. Our massive slowdown in everything, you know? And the numbers are going to come out pretty soon on China. And I think they're going to be absolutely horrendous and they're going to be shocking. That alone could bring down the world economy. Okay, so it says China slowdown, trade and stocks connecting the dots. China's slowdown has been making global headlines, and so has news related to the U.S.-China trade war. More recently, phase one of their trade deal. If we move beyond the pessimistic headlines, we can see equity markets are pretty much on a joyride this year. U.S. markets are hovering near all-time highs, while Chinese stocks are also sitting on strong year-to-date gains. Does it all add up? No, it doesn't add up. You know, considering what's really going on in the financial system and in the world and how we're heading into a recession. Everybody's so quick to forget about the yield curve inversion, which always precedes a recession by a few months. That was a few months ago. So what do you think's going on with that? Now, over in the United Kingdom, they're going to vote. And they're divided over who can deliver the Brexit, you know? But it doesn't matter. They want the Brexit. They voted for it. They want it. And this is going to create a lot of turmoil. Meanwhile, the United Kingdom's economy is slowing down toward a recession. So is Germany's. Now, I said I got a lot of information to cover here. I'm trying to move through it rather quickly. But there seems to be a little period right here in the world in general leading into Christmas right now, where they're kind of forgetting about all their problems. They're kind of forgetting about, suddenly everybody's forgetting they're into Christmas and everything. And I'm not saying there's anything wrong with that. I think it's great. I love Christmas. But the problems haven't changed. They're still there within the financial system right now. And when the new year comes, I think it's going to be smack in our face. Big time. But I think we're going to get through Christmas this year. So you guys have a great Christmas, and really enjoy the holidays, because come New Year's and into the first part of next year, I think things are going to turn down big time. Now, let's take a look at EU. The EU is warning France and Italy on high debt levels. Next year's budget is at risk of breaching EU's rules. Okay, they got a lot of rules in, but it's not just France and Italy. It's also, it says the EU executive in charge of monitoring budgets of the Eurozone countries also said that the draft budgetary plans of Spain, Portugal, Belgium, Slovenia, Slovakia, Finland were at risk of breaching the EU rules also. Now, they're caught between a rock and a hard place. And the reason why is to lower these budgets down means that the people are not going to be able to have, they're going to have to cut back on pensions and everything else. The people in Europe have just about had enough right now, the way it is right now. How are they going to feel about having austerity measures put on them? Further austerity measures put on them. This ain't going to fly very good, And so the governments in these countries, they need these budgets. And the EU is saying, well, we can't give it to you. We don't have enough money. You have to come under budgetary plans. You have to meet the EU rules for debt and deficit reduction. In other words, you have to cut back. And nobody wants to cut back. This is the thing. Now, we're going to move on here. New bubbles mounting debt. Prepare for the coming crisis. Financial markets roil and the banking system groans. The U.S. Federal Reserve cut interest rates, even as Chairman Jerome Powell claimed that he expects the economy to remain strong. Meanwhile, the Fed is forced to intervene to lend emergency cash to banks, shoring up their pensions for the first time in 10 years, as an already struggling working class glimpse the early outlines of yet another mounting crisis. Fears of recession mount. And it says, and well they should. This hasn't went away. It's only went away, I think, until Christmas is over and New Year's is over. I think this is going to come back with a vengeance in the early part of the next year. Deutsche Bank, right here. Probability of bankruptcy. Now, you guys ever notice something? When they give something like a 20% probability of happening, that's a very high probability. It means it's probably going to happen, and they give it 20%. Deutsche Bank's probability, if we look down here on this chart right here, we can see the lowering of the revenue. 2010, their revenue was like, what's that, 4 billion, and then in 2018 it was 3,600,000,000, and now it's projected in 2019 to be 2 billion. So it's just dropping off a cliff. Consolidated income is really dropping off a cliff. Look, 2018, 12 billion. 2019 projected, and they always project the numbers higher than what they're actually going to be, 7 billion. It's almost being cut in half, and they're giving Deutsche Bank's probability of bankruptcy at 50%. I mean, that's huge. And of course it would be. We got to keep our eye on Deutsche Bank. Deutsche Bank is one of those things that could just sneak up on us out of nowhere and suddenly be bankrupt. In fact, there's already been rumors that they had filed for bankruptcy, but I think they were just rumors. Moving on. Hong Kong. Heavy toll. Hong Kong confirms its economy is in a recession. First full-year contraction since 2009. Amazing, Hong Kong. Now, Hong Kong is the business hub for the entire world, for the entire globe, for the entire part of, it's not exactly the business hub for the entire world, but it's the business hub for all of Asia. It's a very powerful, for business, it's very powerful. In the real estate market in Hong Kong, the amount of stored value in the real estate market, that's going to just crumble. So this adds to the world's problems even more. Plumbing problems in the repo market. Well, that's been in the news an awful lot lately. This is a meltdown within the United States' financial system itself, this repo market, and they're just flooding money in it, trying to patch the hole. And it's a huge, leaking, gaping hole right in the center of the world's financial system. And this is just part of the problems. So what we got is here, we got deflation that's trying to come in. A huge deflation. It can come in suddenly. It can come in actually overnight. It can actually move through the system as fast as computers can send information between each other, between these banks. And it can freeze the system up. Then we got inflation on the other side of that, and that's the reaction to deflation by the central banks. We're playing a very dangerous game indeed. I can't begin to tell you guys, you could actually wake up some morning and everything actually be frozen. What would that be like? Well, it would simply work like this, is there'd be capital controls in place. You'd only be able to withdraw a certain amount of your money because of capital controls. There would be big long lineups at the ATM machines. And they would be the sort of thing where they'd fill them, but the lineup would only get halfway through and the ATM machine would be empty of money. And so oftentimes you'd have to be first in line when they're refilling it. None of your cards would work. Your debit cards or anything else, none of that would work. it would be just a horrendous situation that they would have to react to and fix. And what they would do to fix it is they would run into the system, the Federal Reserve, it would run into the system and try to shore up the institutions that are in trouble as fast as they possibly can. This means printing over everything, just like they did with the repo market. I feel fairly confident that they could get things back up and running, but how long would it take them? 2 weeks? A month? Meanwhile, you're sitting there and you know there's going to be runs on the grocery stores. There's going to be empty shelves. It's just going to be a horrendous situation. And this is the kind of thing the situation that we've gotten ourselves into because the entire monetary system is structured wrong from the very floor up. Thank you guys for listening. Like and subscribe. Give me a thumbs up, and we'll catch you guys in the next show. Bye-bye.